and welcome to the midweek edition of Dukascopy's Targets and Focus programme. Joining me down the line to discuss his forecast for some of the most traded currency pairs is Dr. Bernd Berg from Credit Suisse. Now, today marks the last trading day of the month, and what an eventful month it has been. Analysts are already trying to calculate the cost of Hurricane Sandy. German retail sales have come in better than expected, while EU unemployment rate caused disappointment as it rose to a record of 11.6%. But Dr. Bernd, what is your take on the market's response to these events and data releases?
Yes, I think the market is definitely calculating the costs of Hurricane Sandy. I think it's estimated at around 20 billion. So in the focus of the market after the storm passed is definitely some economic data this week. You mentioned the German data, which have been encouraging despite unemployment still high in the Eurozone. But I think the market focus is on PMI data coming out of the US, coming out of China, and also this week we get the European PMI data. So expectation is that growth is stabilizing, with the PMI data showing an improvement, especially in China. The market is expecting that the data is coming above 50. So sentiment at the moment in the market is positive in terms of significant expectations that growth is bottoming out, which should be reflected in the data we are seeing in the next day and the next couple of days.
Bank of Japan easing benefited the rand, having buoyed commodities including gold, while also sparking a euro-dollar rebound. I understand you're expecting US dollar rand to rise to 9.0 figure, but what are your predictions for the 3 months and 12-month mark?
Yes, we think that South African rand definitely is a high-yielding currency which should profit from a positive global risk sentiment. So always when you see an improvement or rebound in markets, South African rand also is supported. But generally speaking, domestic fundamentals in South Africa, in our view, are not encouraging. We see that growth is deteriorating, with PMI around 46, PMI numbers in South Africa around 46. We see that strikes are still a topic in South Africa. Inflation is high, or expected to become higher at the end of the year, also due to significant wage increases. And at the same time, we face a current account deficit which is rising significantly over the last couple of months due to falling exports. So all in all, we think that South African rand will fall. We predict that 9.00 against the US dollar is a target over 3 months and also 12 months. So we are negative on South African rand due to negative domestic fundamentals.
Traders in Brazil said although the Eurozone sovereign debt worries have eased in recent days, there's growing concern about the US fiscal situation given the tight presidential race. But what is your short, mid and long-term outlook for the Brazilian real against the US dollar?
In Brazil, we think Brazilian real is at the moment kept in the hands of the authorities, so it's not a really free-floating currency at the moment. It's a managed float, and the authorities have indicated that at the moment they feel comfortable with levels around 2.02 or 2.03. Wouldn't let the real appreciate above 2.00. So it's managed at current levels, and we expect that real stays managed at the current levels till the end of the year or beginning of next year. Obviously, if we see a rebound, and we expect a significant rebound in economic activity in Brazil beginning or middle of next year, and once we see this rebound in economic activity, also with inflation potentially rising in Brazil, this could have a positive impact, and authorities would in this case be happy to let the real appreciate above 2.00, and our target is 1.90 at the end of next year.
And finally, over the last week, the rupee weakened against the dollar as the RBI revised downwards the GDP growth prediction for 2012 to 13. But what are your predictions, and what will be the main factors driving this pair forward?
We think, we predict over the 1 month it will trade in a range between 52 and 55. We think it's currently driven by discussions about growth and inflation. Inflation is rising, so the inflation forecast has been adjusted to 7.5% through the year to March 2013, while growth has been revised down to 5.8% from 6.8%. So there's an ongoing discussion if the central bank would cut rates. At the moment, there's a concern about inflation, and they decided to keep benchmark rates on hold, but potentially they would cut rates beginning of next year if inflation recedes. At the same time, also, we have current account deficit concerns in India. But having said, some domestic concerns have receded in the last couple of months due to structural reforms which have been decided by the political parties, and based on this positive sentiment towards structural reforms in India, we saw that capital inflows have increased, which boosted the Indian rupee from levels around 57 now to 53, 54, and we think that it will be range trading. We predict in 3 months it will trade at 53.5 and 12 months 53. So based on domestic fundamentals which are mixed, but a positive external environment with capital inflows, so the rupee will be range trading in our view.
Dr. Berg, thank you so much for your perspective today. Well, that's it from me at the moment, but click back to Dukascopy for the very latest updates throughout the day. Bye for now.